Welcome back to the Capital Mindset Show, everyone. Hope you guys are having a great day out there as always. Today's going to be a video talking about what the heck's going on out there with CPI and stuff. Everyone's making videos about CPI, and it's kind of cringe, okay? Because just for a second, just entertain this idea. Let's all sit back, relax, think about this, all right? We're going to take backward-looking data, use this data to make decisions about investing, which is supposed to be a forward-looking activity. Okay, let's keep it like that, all right? So backward-looking data translates to superior results in forward-looking activities. Okay, you see where this is going? Right, all right. So from here, let's kind of talk about this a little bit, because it's enough of being the facetious side of me. But we got a higher than expected print in the CPI, about 9.1. The core was about where, more or less, where people kind of expected. But there's a big problem. There's a big problem, all right? So this is, again, backward-looking data. This is for the month of June, right? This is June's data. What about July's data? What about now? What about now? What about in the next month, and the month after that, the month after that? So if we make our investment decisions based off of this data, this is not going to yield high results. This is why a lot of these super investors have said in many interviews over and over and over again, the retail investor has no business focusing on macro data. In fact, it is going to be more likely to be to your detriment to focus on this kind of stuff. And if, the mainstream media doesn't actually help you on this regard, because remember, their job is to create content that generates views. Very similar to the average YouTuber, actually. So actually, quite literally the same as the average YouTuber. The incentives are to generate content that gets views, not necessarily generate content that gets value out there. And this is actually a point that I want to shout out. Investing with Cole made a very good video specifically about this. In fact, we're going to highlight his video here. So just a quick, cameo. Here's Cole actually talking about this. He says, how to find a good investing YouTubers to watch. I recommend to watch the video. It's a short video. It's 3 minutes and 23 seconds. And in this video, he does describe a lot of the characteristics that you might find in some of these content creators. But specifically what I'm going to highlight, and again, I won't spoil it. Go watch it yourself. But one thing that is kind of prevalent in this theme that is kind of shared with the mainstream media is that attention to create content that generates those clicks, okay? And so it's not necessarily about you, the viewer. It is about, generating the viewership, okay? Making you click on the content, and whatever that is, it tends to be a lot of negative content. It tends to be a lot of content regarding, for example, inflation, something that the average person can kind of understand to the point where they are interested in clicking on it, but not actually explain anything further than that, aside from how it can be helpful to them in regards to perhaps their investing journey. Because that's not the goal. The goal is just to get you to watch, and that's about it. That's where it ends, okay? In reality, if the information was so valuable, it would be a lot more easier to actually generate mindful decisions and actually make some money, right? So, but they're not really going to do that. That kind of information is typically behind paywalls, and understandably so. If you are an individual who's providing significant amount of research that does provide tremendous amounts of value, heck, I would pay for it. All right. So that's kind of the distinction here. And, mainstream media is not really going to be able to do that, right? Because that's not really their goal whatsoever. So under that context, I want to actually show you this is not to pick on this person individually. Some of you like him, some of you hate him. I'm going to remain neutral, be very diplomatic, the classic capital mindset style. But I know that sometimes I'm not, but let's try to be here. So I'll play this video and kind of hear his thoughts, but kind of get the idea.
We are now over 9%. We've got a month over month at 1.3% in June, folks. You can't even make this stuff up. How bad that is. I got to go to a calculator just to do the math here. 1.3 at an annualized rate. We're at 15.6%.
So excited, so excited, so amped up.
This is absolutely nutty. What went freaking nuts in June? Holy crap. June. Used cars up 1.6%. Are you freaking kidding me?
I'm just noticing, I don't know if you guys are seeing this on the side, but there's a lot of people in his chat talking about Mullen. I don't know why it's like Mullen. I see it's a couple times here. Mullen. Is he invested in Mullen? I don't think so, but whatever. I don't really care. But yeah,
Everybody's like,
you
oh, no,
see his excitement.
Used car bubble has popped.
Okay.
It's over. Used cars are over. No,
he's
it ain't.
really excited. But anyways, you could also kind of go from there and go online, and you say, oh, I'm going to search up inflation. And then when you search up inflation news, you're going to get this, right? So you're going to see information from 23 hours ago. You can kind of see why it is political. It can get political. We also have an election year coming up. So that actually, throws in a whole mess as far as what, the government was looking to do, how the politicians are going to be able to handle this, or, handle this either verbally or through policy, et cetera, blah, 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 blah. So all of this jazz, this is what the average person is going to look at today and for the next couple weeks. And they keep looking at month over month over month. Even though it's backward-looking data, it's not really going to drive any meaningful decisions. Now, if you made a decision based off of past or backward-looking data and you got it right, that's actually just pure luck, because you're not really looking at any data that's going into the future, right? You're just looking at what's happened here for that month, but what about now? So we've been talking about on this channel for quite some time, I guess I don't know how many videos we have on it at this point, but regarding energy prices, regarding industrials, you'd look back at the industrial videos, I talked about that there. But basically what you kind of need to get up to speed if you're new to the channel is that, yes, we see a lot of forward-looking data saying that the economy is not doing so well in a couple key areas. And longer term, there are some very big and powerful trends that are not going away anytime soon. I will share with you some of those charts. These will be some macro charts that I'm going to disclose with you guys here today. We're going to have a conversation about it. Of course, if you guys have any questions, try to comment down below. Or if you want to ask the question live, you can wait for a live stream, and then you can kind of just hop on there and then ask the question there. Okay, so with that being said, I'm going to take you over to some of these charts, and I have them saved here. So let me just pull them up real quick. So the first one I actually want to cover is, let's see here. Where do I begin? All right, I guess we can begin with, because I'm trying to provide the narrative here. So we're going to start, I guess, with this one. This one's probably better. So, and let me actually, let me put this over here and put you guys here. All right, cool. So let's enlarge this photo. Well, let's first see this. Okay, it looks good. Enlarge this photo. All right, here we go. So let's zoom in. So this is actually the population trends of the United States, Germany, and another country, Republic of Congo. So just 3 different examples. United States, I've said time and time again, the demographics of the United States are superior to many other countries. Here's Germany. Some of you might have actually had discussions regarding this. It's split by male and female, by the way, color-coded there. Those colors are pretty easy to determine, even if you're colorblind. But the United States appears to be pretty good. We see, well, better. It could be better, but it's pretty good. And what you can see, characteristic of a developed nation, you have a lot more older people than something like the Republic of Congo, which a vast majority of its population is actually inside of the younger population. It's a classical, pyramid approach. And then Germany's forming that other kind of bell curve, well, not bell curve, but let's say hourglass shape, but the opposite of an hourglass, because it's inside, and then a kind of wide mid-range for age population. You can see 45 or 40 years old to 49 years old to 50 years old being large parts of the population, et cetera, et cetera, et cetera. So what happens with this? Well, there's some other parts that I actually want to highlight for you guys, because let's see, for example, I want to actually pull up this chart. All right, so government debt to GDP. So this is something that is interesting, right? So this actually comes from the BIS report, and BIS put out a really good study that actually showcased a lot of the thresholds for debt among many other countries. And so what happens here is that they kind of calculated and came with a threshold of about 85%. And the United States has surpassed that by quite a bit after the great financial crisis. If you read other people's work, such as Jeff Snyder's, for example, you would know that he believes, or he has stated, and it is his wording, so all credit to him, that the United States has been in a depression-like state since about 2000, or the great financial crisis. Let's just say the great financial crisis. So, and the United States hasn't left it. And then some people might say, oh no, all this back and forth between what is and what is not true. One thing I will highlight, and we'll get to this chart in a second, but I actually want to go over this. So the government often cites that, oh, the debt's risen a lot, but we don't have to spend as much in order to service that debt. And that's very true. We can see that here. As rates have come down, the long-term interest rates have come down, but the trend line is still there. there in terms of long-term interest rates. We'll get to that in just a second. We do see that, yes, the servicing the debt has come down since for the long time period that we can kind of see here, while debt has risen. And we see that chart yet again. So I'm going to show you that chart in a different way. And let me see if I pull up. I think it's, is it this one? No, it is not this one. We'll get to that one in a second. This is the one I was looking for. So let me actually pull that here. So we actually let's only care about this. So let me pull you guys here. There we go. All right. So you can see that this is the total public debt as a percentage of gross domestic product has increased rapidly, actually, since about, again, the great financial crisis. Now, I want to highlight different parts of this chart here for you. So you can see from 1950s around there to 1980s or 1960s, whenever the beginning of it is. But this time period is the baby boomer era. So the baby boomer era, we do see a reduction in that. And we did have a lot of inflation at the time, right? We remember that. Remember, all that jazz. So inflation around there, we see the little recessions that occurred throughout there. So this era was actually fueled by having the right demographics at the right time, that demographic dividend, so to speak. And so we did have a sustained increase in GDP as well. And we'll get to some other data kind of showing this here. But afterwards, we did see an increase in the debt, in the leverage taken on by the system. And I'll show you guys in another chart here. So let me actually find this one. I believe it is this one. All right, so total public and private debt to GDP. Again, we see that in this corner from 1950s to about the 1980s, right here, we do see, oh, and you guys weren't seeing that, but we do see a growth, a steady growth, but this is mainly where we see that baby boomer generation. So going back to, again, this chart here, remember, and actually, I didn't even know I could do this. This is amazing. I can put both of them side by side. We can see that United States today, right, it looks like this, but back in the olden days, it was a little bit more concentrated in the younger generations versus the middle-aged generation. So this is supported by natural growth. All right, so then let's remove that one and kind of focus, well, actually escape there. So let's actually go that, and let's just focus on this one. All right, so and actually, let's go back here. I want to actually take you guys over to, let me see, this one. This is the other one. Okay, so this one actually comes out at about 85% household debt to GDP, similar to the government debt to GDP, by the way. And that's where they actually consider it to be, again, the real effects of debt. I recommend that you guys go read it if you guys are so curious. If you're so intellectually inclined to go read that and you're curious about it, I have at it. It's a pretty good read. All right, but anyways, we can kind of see how the household debt to GDP has changed over time. You can see that the household is overly leveraged, not as leveraged as they were in the great financial crisis, but still pretty leveraged. We see that little blip, COVID-19, and then coming right back down. Now, here is a very important thing to actually take a look at. So let's take a look at this one right here. So this is the cyclical component percentage of GDP with durable goods. So durable goods, housing, things that go in your house, such as appliances, all that jazz. So we can see how typically we do see a average of about 13%, and then the baby boomer generation got us to about 14%. We need this to have a sustained period of economic growth. Now, what do we see at 2007 of the great financial crisis? We see a massive drawdown there, and we see us reach an average of about 11% there, highlighted by that red. So not good. Red equals not good. And currently, we're sitting at about 14%. But remember, let's go back to the other chart. And we're going to see a decent amount of debt. So this is basically telling us that that 14% level is not fueled by a massive amount of leverage, but this current system is fueled by a massive amount of leverage. So this actually tells us that, hey, potentially speaking, we are in an era of high leverage. I'm being facetious there. Obviously, we are. And the government has taken a massive or a larger role in taking on that debt. So this is another thing that I want to actually highlight. This is retailers' inventories to sales ratio. So remember all that inflation? Well, remember when the Federal Reserve is kind of a funny institution because they're also, believe it or not, super surprise information here. Never heard this before, blah, 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 blah. The Federal Reserve is heavily influenced by politics. So if they are heavily influenced by politics, let's kind of break that down. Well, that means that a lot of things they say and do are going to be influenced by politics, all right, which is influenced by general sentiment. So they've been saying for a while, inflation is transitory. The issue with what they were saying is they were saying it way too early, okay? Way too early because they were they were misjudging the effects of what government policy did, all right? Government policy got everyone into the situation. Everyone kind of says, COVID-19, but, controversial point here. technically speaking, it was government policy that did it, not necessarily the COVID-19 pandemic. COVID-19 pandemic was the conduit for which government made the excuse to do the actions they did, which, if we pinpoint directly, is what caused a lot of the damage that we see today in terms of supply chain destruction, etc. So this data actually just shows us the inventory relationship with sales. So it's an inventory to sales ratio. So basically it tells us how much inventory is on hand to kind of fulfill the total volume of sales. What we do see here is a massive drawdown over the course, and that kind of shows us the inventory levels have been suppressed for a large portion, and that would of course indicate that, you know, there isn't enough to sell. Prices must go up, right? The supply is not there. We see a lot of goods, right? You've heard other creators probably talk about this, some of those macro creators, or even maybe on the news they talk about it here and there, you know, saying, oh, well, we have all these ships on the coast of California with all these products in them, and that's all, you know, waiting to come in. Yeah, that's basically what this is showing. The inventory isn't coming in fast enough, right? It's not in there. So of course you're going to have a sustained period of inflation. I think that's almost like the obvious thing. That's obviously going to happen. Now, we see energy prices. Energy prices go elevated, right? They rise up, and I'll actually pull up another chart showing that. Again, kind of like looking at past data, it's pretty problematic. You kind of see where I'm going with this. So this is actually, I'm using, by the way, all the sources I'm using today on purpose are all free resources. Because many of you ask me sometimes, it's like, oh, how do I find, you know, data? Really, what it takes is kind of taking a critical approach to the things and thinking about things. And then, you know, there's plenty of free data resources. You don't really need to pay tremendous amount. By the way, just to be very clear, if I wasn't clear about this already, the vast majority of decisions should not be centered around a macroeconomic approach, right? You should just basically be focused on, you know, focusing to your strategy, focusing on your core competencies. If you're an index fund investor, dollar cost average, regardless of what's going on, paying attention to this stuff is not going to be, it's going to be more of a headache. Maybe do it for entertainment at the most, but yes. So we're looking at just a month ago and kind of looking at the current average. And again, free resources. This is gasprices.aaa.com. And you can see that they keep track of this data. They publish this data for free. And you see current average, yesterday's average, week ago average, month ago average. So basically what I'm doing here is trying to do this entire video only using free resources, free information that is out there to kind of show everyone that you can, in fact, collect enough data to kind of draw different distinctions or draw different opinions relative to or different from some of these other people who are kind of just espousing past data and as if it's something special. And it's nothing special. It's terrible. It's terrible. You should not do that. All right. Anyways, so current average is about 4.63. Anecdotally, I've spoken to many of you across the United States. The capital mindset community is pretty vast. You know, aside from Europe, in the United States, gas prices have been coming down in a lot of areas. I can tell you in my area, it's been coming down quite a bit. It's noticeably different from about a month ago, which is actually, funnily enough, because I have two vehicles, an electric vehicle and a gas-powered vehicle. Well, I'm getting rid of actually both of them for just having one electric vehicle. But aside from that point, when I refilled the car, because I kind of use mainly the electric vehicle and sometimes use the gas-powered vehicle, so I filled it, I think, quite literally a month ago, and I filled it just actually the other day. I noticed the price difference, and I use it through my app. I can see what I paid for last time. Okay, so it's remarkably lower, or noticeably lower. And we do see, okay, so a year ago it was $3, a month ago it was $5, and now the average is sitting at about 4.6. This is not reflected in the current numbers. All right, so you are going to use the numbers, whatever numbers you choose, and you're not going to use the current numbers. You're not going to use the current trend, right? So you're not going to take that into account. Of course, you might say, okay, I look at this data and then I take this into account. That's mainly basically what you want to be doing. But yeah, so that's kind of just an example that I wanted to highlight there for you guys. So all in all, let's go back to this chart because I think this chart's really important. So where we're probably going to end up going is right back down to the 11% range. And you might remember hearing that, you know, oh, after the Great Recession, we had a very anemic growth. We didn't grow. It was the slowest recovery ever. Well, this is actually why, because you can see the percent component of durable goods consumption dropped to an extraordinarily low level below trend line. And again, remember, what has Jeff Snyder been talking about as a bit of a problem? Well, that we are below trend line. And I'll actually highlight that, you know, because I have that chart here too. I've talked about it in other videos, but I have to, you know, remember that there are those among us who are actually newer to the channel. So I'll show this as well. All right, so let me put this here. So this is actually the real per capita GDP versus 2000 trend. You can see that the 2008 levels have really thrown us off course, but it actually, this trend line started from the year 2000. So we know that from 2000 to 2006, 2008, this growth was mainly fueled by a lot of leverage. And government has been coming in and taking on greater sums and sums of leverage to try to boost the economy in their own respect. Of course, they keep trying to do that, and we don't see the effects. Therefore, what the solution is going to be is do more of it. So we've heard, and I've kind of mentioned this in the past, that a Japan-like scenario is pretty likely. Not exactly the same. It's not going to be the same, but it's going to rhyme with it. So as in, the government's going to do certain actions that is going to cause a certain effect, and then they're going to say, okay, well, we're going to do more of that same thing in order to generate not that thing, because they think they're going to do something to stimulate growth. Remember that government typically is always the one that tries to take credit for example, economic growth. You hear the White House and whatever administration you care about, it doesn't really matter. It's typically always the same jargon. It's typically, we created this many jobs. We created this many, blah, 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 blah. So usually government likes to say, this is what we do. So remember that they kind of look at it from the perspective that they have an effect and that they must be able to do something. Of course, what's probably going to happen is some sort of crowding out effect that we've talked about. We've also, talked about this kind of data. So, the money multiplier effect. Money multiplier effect has come down drastically over time, and we are hitting levels right now that, well, we're pretty low. And if you think that United States is alone in this, I mean, heck, I have a surprise for you. I've shown this to you guys in the past as well. We see the four major economies. So you can see this trend line of China. China is actually pretty abysmal. So if you think about all the things that have been going on in China recently, there is there's kind of like a lot of problems in China. For example, they have a demographic problem. We just found out, for example, with the leaked data that they overcounted their population. So that's a bit of a problem. They also have an issue with, their banking system, kind of showing here. So this data was already, and I've already made videos on this, that if you looked at this data and you say, they were growing about blah, 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 7% or whatever. Well, that means that they must have been doing something to play around with those numbers, not necessarily even lie. That's a separate issue that we'll put a pin in that, and you may be right on that, but let's put a pin on that and put it to the side. What it does tell us is that there's something else going on. The story is not so simple. We can't just simplify the answer to this and say, they're just doing that. They're just growing, right? They're just growing at 7%. No, this data is this single number, right? This money velocity number is just telling me something is weird about the story. It doesn't disprove it. It's just telling me something is very, very, very strange. Okay, and then requires further investigation as to whether or not that growth is real or not real. Now, anecdotally, what have we heard about with China? Stories have been coming out of China for a really long time, going back into early 2010s, that they build cities to nowhere, bridges to nowhere. They just build a bunch of infrastructure. And let's face it, infrastructure building is only good up to a point. Afterwards, it has diminishing returns. You see where I'm going with this? Okay, so pretty straightforward stuff regarding that. And there's also some other data I could put. So diminishing returns of debt. So the government's going to take on more and more debt, and there's a diminishing negative multiplier effect eventually that actually does. So we talked about this in the past, that at some point it's very difficult to really determine this. Different papers, different studies have made different claims as towards the best optimal amount of debt. In reality, it's not really about the amount of debt. It's more so about where that debt is being utilized. But what the numbers kind of say, statistically speaking, is that you're more probable to squander spending after a certain percentage point. So it's pretty easy to get carried away with that spending. And then you get what's called malinvestment. Malinvestment is very difficult to really measure until the effects are kind of showcased in the economy. Okay, so a form of malinvestment, let's say, is that, in reality, the most efficient product spend would be product A. The government comes in and says, no, I know the market wants to go to product A. I'm going to take resources from the market and put it into product B, right? And so that's going to, have its own effect later down the road. You can't escape malinvestment. Malinvestment can oftentimes show itself in many different ways, not all the time spending, but spending is one way that we can kind of more quickly visualize that. So other kinds of stuff that I have talked about in the past is the aggregate shift of the supply curve, kind of coinciding with the other charts I showed you, that yes, a lot of the price hikes, a lot of the increase in prices has been from supply side destruction, okay? It has been, almost objectively. So what what does that mean? And this kind of goes, and I will be doing a video probably this week focusing on the effects of QE and specifically breaking down QE because I don't have a video dedicated to that. I just have many live streams and different discussions with you guys about this, but I'll kind of break it down in a easy to kind of understand video with visualizations and everything. But what you have to understand with this is supply side destruction did occur. What we saw with oil, right, is further destruction by the consumer's pocketbook because we have, and this, I think there is a video on this specifically, but we saw that oil prices rising, right? The consumer has only so much to spend, right? They have the necessities like housing, food, and energy. And if those rise past a certain point, guess what gets destroyed? And we saw that in the CPI print, by the way. We saw a decline in a lot of that discretionary spend. So that trend is probably going to continue. That's the trend that's already started. But what the information is missing is that we should also see after a certain point, the destruction in energy prices. And this is where I'll kind of get to where I had a discussion with you guys on the Discord yesterday on the call, the weekly call, you guys already know that I already sold out of oil. And so what do I mean by that? Where am I going with this? Well, we know that Buffett's been buying oil. So Buffett is doing it from a different perspective. He's more than likely buying in from a different time frame than what I am or what I was, right? I took all my profits from oil. However, I think that Buffett's thesis is probably correct. If you actually look at the CapEx investment that's been going on in the industry, it's rather tamed or rather suppressed for a variety of reasons. But regardless of what you believe, it has been suppressed. So what does that mean? That means that there's a decent amount of potential for a good next 10 years for oil after we get through this, crunch or the finalization of the liquidity crunch, so to speak, which culminates in some form of recession. Don't know how severe, but that's where the end result is. And from there, the world can probably recover. But despite that, I think that all roads or all arrows are pointing to that, and that does lead to a rejection in higher prices and the real cost or the real threat, which is actually a bit of deflation. So that's the real threat, and it could get pretty bad. And this is the problem, and I hope you guys enjoy the video on QE because QE, it really needs to be a good understanding of QE because there's so much misinformation on QE out there. And it's really annoying, right? But we'll get to that. So on that note, guys, thank you guys so much for watching. I kept it at under 30 minutes, but this is exactly why, it's really easy, guys. All that you need to do to get rich is to watch CNBC, right? Watch CNBC. Watch daily videos about what's changed in the markets and invest accordingly. It's obvious. It's that easy, right? That's how you do it. That's how you get the right information. It's not about, taking critical analysis or taking all the free information I showed you guys here today that is freely available and kind of thinking critically about it, or just better yet, just ignoring all that and just focusing on your strategy. Oh, no, it's not about that. No, definitely not that. What you got to do is look at information on a daily basis about what the heck's changing in the markets and invest according to that, because that's how everyone has become rich. That's how you become rich. It's a proven, successful strategy, and if you don't think so, you're just a poo-poo brain, okay? Bye.